Hi everyone, welcome to the weekly market wrap up. I'd like to start by talking about the key benchmark interest rates. So, US and UK, both these countries have hiked their benchmark interest rates by 375 bips and 275 bips respectively year to date. So, the US benchmark federal fund rate stands at 3.75 to 4% as a corridor, whereas the UK funds rate stands at 3%, compared to India, where the repo rate right now stands at 5.9%. And hence, compared to the historical average of the spread between India and US, which is at closer to 500 to 550 basis points, right now it only stands at 175 basis points, which shows that India has enough legroom to hike the interest rates. The liquidity tightening that is happening across the globe is making sure that we come down from the record high inflation levels that are currently present. The week that went by, we saw that the GDP for India's quarter 2 FY23 came in line with the RBI and the Bloomberg expectations of 6.3%, and the GVA came at a record print of 5.6%. So we can see that compared to quarter 1 of FY23, the GDP was at 13.5%, and hence the base effect has started normalizing from quarter 2 onwards. The GDP growth that came in at 6.3 was front-led by the private consumption and the services sector, growing by 9.7% and 9.3% respectively. The manufacturing sector contracted by 4.3%, mainly because of high raw material prices and uneven recovery in demand. That is a key reason for the drag of GVA that we saw. The demand for consumption is expected to remain robust despite the global headwinds because of strong domestic demand, and the GDP for FY23 is expected to be pegged at 7%. That is as per the RBI estimates. Moving forward, the FPI investments have turned positive for the month of November again, with record inflows of 36,000 crores, mainly because of inflation print easing off, positive domestic macro fundamentals, less hawkish stance by US going forward, as MPC usually has a long and lag effect on the economy, and hence Jerome Powell has expected that going forward the interest rates will be starting to taper off. Positive US GDP coming in at 2.6% in quarter 3. This positive GDP is only because of the strong labor markets that we're seeing, growth in exports that came in the US economy, the consumer demand, and the narrowing trade deficit. Talking about banking sector, so banking sector has been an outperformer this year because of improving credit quality, retail assets growth, and penetration, mainly having strong focus on retail yields, most importantly because of the rising interest rate environment scenario. So essentially, in a rising interest rate scenario, banks tend to benefit because their NIMs expand, and because of which they have a higher yield on advances. Instead of the rising interest rate environment, the credit offtake right now stands at a record high of 17.94% because of retail and working capital demand. This chart talks about the Nifty PSU bank returns and the Nifty bank returns that have outperformed the Nifty 50 and Sensex returns. So the Nifty PSU bank return stands at 58%, the Nifty bank stands at 18% compared to Nifty 50 and Sensex that have an absolute returns of closer to 7%. So banking sector has been quite positive because of the interest rate hike environment, and it is led by healthy advances growth, increasing NIMs, increasing asset quality, and good growth in the return on assets coming in. We remain optimistic on the banking sector with sustainable growth seen across top tier banks. As such, companies that are focused on the domestic economy will continue to deliver healthy numbers as India continues to be favored compared to the peer large economies because it has a relatively higher GDP growth rate. For the equity markets, the week went by positive, with Sensex and Nifty both closing in higher by 1.6% for the week. The markets have been positive and cheering mainly because of positive FPI inflows that came in for the month of November, lower inflation print, and strong domestic macro fundamentals. The outlook remains positive as India continues to have good tailwinds despite global headwinds because of strong credit demand, real GDP growth rate, GST collections, PMI numbers, adequate forex reserves, low external debt to GDP ratio compared to the emerging economies, and we believe India has strong and stable macro indicators compared to its peers. RBI is at the forefront to efficiently manage the yield curve by taking proactive steps to battle the prolonged pandemic fears, rising inflation worries, and making sure that there is long term growth for the economy. Thank you.